Today, folks, on the back of what is likely a recession here in Canada, our stock market, absolutely crushing it. And VDY, my favorite monthly paying Canadian dividend ETF until I die, is absolutely crushing the US markets, which is nothing short of exceptional. The S&P up 14%. VDY, might I add, before that monthly juicy dividend, is up 18%. And on the 5-year, it has offered less volatility in better returns. This is a peculiar moment on what should be, a horrible market environment. But when you look at stocks across the board, precious metals, one of the most insane markets this year, but the banks coming back with a vengeance, even on the back of lower oil prices. Oil stocks are doing pretty good here. And I want to break some of these stocks down because you know them, you love them. We're in the midst of earnings season. We're going to talk about telecom giants with Bell, Fortis in the utility space. We'll talk about Canadian Natural Resources, which is continuing to propel when it comes to their bottom line production, which makes my jaw hit the floor. So if you're on a path to financial independence, if you love these kind of stocks, consider hitting that subscribe button because they're the biggest companies in Canada. They sit within VDY, the ETF that I cost average in to get exposure to these companies. So yeah, I love them, right? And Bell, I think, is starting to prove out, and I've said this time and time again, even though it's my least favorite telecom giant, it is finding a bottom here. And I think the telecom space has bottomed out after the wicked crash that this stock specifically has gone through, taking prices back all the way to the 2008 financial crisis like level here. And investors are starting to recognize that, hey, maybe we should be picking up on the earnings. So after earnings, the stock is trading up just about 1% here. Not too bad with a 5.35% dividend. Might I add, that dividend cut was insane. I mean, they had no choice. Investors were asking for it. I think it was insane for them to try and keep the absurd dividend yield and the lack of cash flow to pay it, using debt and other structures to try and just keep investors in. But 44 cents is what it dropped to after being a high of $1. And that takes the yield back to where it was back in 2010, which is, again, kind of reminiscent to the stock price trading back toward 2010, 2008 like levels there. So yeah, kind of makes sense, I guess. Regardless, I just want to point out some of the metrics here because they were actually more resilient than I think people were expecting. I mean, this company has got a few diverse businesses. They're basically a telecom provider for cellular network, obviously wireless, internet, and then of course you have Crave, right? You have their media division, which includes CTV, some pretty major networks. I hate this division. They've actually sold off a huge chunk of it. And the big thing they're leaning into is Crave, but I think there's some level of manipulation going on here. Have you recently signed up to Bell or Rogers? Because when I got Rogers in my place, they forced me to get a Rogers box. And I said, I don't want your streaming box. I don't want it. Well, you don't have a choice because it's part of the deal. And to get the deal, you have to get the streaming service, which has sat in a box up in my closet for the last 2 years. And I think, Bell's probably doing something very similar with Crave because their numbers are up 24% year over year. Digital advertising revenue is up 21%. I can't help but think this is just through the add-ons of getting, internet at your place, more or less. But regardless, you got to admit that, even on the back of lower immigration growth in the country, the rocky economic outlook, the operating revenues are up 1.3%. And I know this is not a growth company, guys, but having this kind of stable revenue gives them some optionality in this lower interest rate environment to shuffle around some of their debt. I mean, they did some mass layoffs. They probably are getting through the severance packages now, which is leading to insane free cash flow growth. I mean, they're up 20% from 832 million to over $1 billion. This is why I'm calling a bottom in the space, because we're starting to see the recovery in cash flows. So this is an opportunity for investors out there to pick up some shares. Again, I'm not the biggest fan of Bell or Rogers because I just don't like their media divisions. I'm a YouTube guy, diehard YouTube guy. I don't like Netflix. I'm not buying any of those stocks, but Google is where I live. Regardless, I think Telus is going to be the exception for me anyways in the telecom space for a stock that I would buy. And I keep debating and I keep telling myself I should pick up some shares here. I know the dividend yield's over 8% and they need to promote cash flow to secure that dividend, but a lot of analysts aren't expecting good earnings this quarter, and we're getting that posting tomorrow, and the stock is basically almost flat on the year now, right? And this is my favorite because you get security. Telehealth is a massive growing sector for them. They have no involvement in the media divisions, which I love the most. They're more expanded into more, secure, pun unintended here, businesses. So I'm much more looking forward to their earnings over the other ones. So you can subscribe for that. But pivoting into the sector I'm most intrigued by because I think it's one of the safest sectors you can get involved in on the back of interest rate cuts. These are highly infrastructure oriented companies. They have a lot of debt, but we're getting the onslaught of AI, the electrification of everything, and utilities are going to go into what I'm calling a new growth phase. At least the total sector, the TAM, the total addressable market, I think is going to expand a lot more dramatically than even analysts are expecting. And Fortis, not really actually up all that much over 5 years, but starting to get a new growth wave with a lot of those gains coming within the year, up 20%. The yield is kind of more in line with the historical averages. It has been a pretty good grower overall. I mean, if you take a look at the dividend scorecard here, I mean, the dividend is growing at about a 5% clip right now. I think they just increased it 4%. That's the guidance, is about a 4% increase. And this is about a normal dividend yield. It's nicer when you can cap in around 4%. So it's a good stock to buy on the dips. But this is one of the largest utility companies in Canada that expands into the United States with 94% transmission and distribution assets. Obviously 100% regulatory utility assets. 5.6 billion is what they're expecting for capital expenditures. I mean, they almost employ 10,000 people, which is insane, right? But Fortis, yeah, I mean, if you take a look at the recent earnings they just posted, they were good. I mean, they're growing at a very reasonable clip here. I mean, the revenue is 2.9 billion versus 2.7 this time last year. Again, these aren't like the fastest growing companies, but they're very consistent. The yields are very reliable, and over time they tend to offer pretty reasonable returns. The average annual rate of return of Fortis has been around 10% for the last 20 years with 50 years of dividend growth. Again, it's hard to look backwards because if you look backwards on Bell, you'd think it was a great company, but I think this company will have a bit more of an exception to maybe the telecom space because of how consistent and reliable utilities are and the demand for electricity continuing to grow. So I'd keep an eye on here, guys. This is a stock I like a lot, so we'll see how it goes. I prefer things like Hydro One. I like the more knit focused utilities. This is a much more broader, expanded utility. I prefer the ones that are like Hydro One is very focused here in Ontario, and which is a very fast growing province. But I like the smaller utilities because they have good room to expand, especially the government regulated ones. Regardless, though, let's take a look at CNQ, Canadian Natural Resources, which basically hasn't done anything since 2022 from a capital growth standpoint, and that's because oil. If you don't know CNQ, guys, it's like one of the largest. It has the largest natural gas reserves and the largest oil reserves on the planet. A lot of room, 40 years of reserves. So this company's going to be producing for quite a while, but it goes through these cyclical periods where if oil's not doing anything, this stock doesn't really do anything. And oil's now down below 60 a barrel. It's dropping back to prices, we haven't seen in these are pretty low prices, right? And there's a lot of cyclicality to this. So, with oil production, without an economic, geopolitical event, it's likely oil can stay down for a while. That's why I don't typically on an individual basis own oil or commodity stocks because of that cyclicality. But I have to recognize that Canadian Natural Resources is nothing short of a miracle here. I mean, their growth rate on the dividend has been disgusting. I mean, take a look at this. The dividend growth rate on Canadian Natural Resources has been 23% a year for the last 5 years. Absolutely insane. And if you take a look at the yield overall, guys, which I'll zoom in just a little bit here to show you that even today, the yield at around 5%, just over 5%, is actually one of the higher yield periods for this company. They have peaked at almost 6 to 7%, but typically anything over 5 is historically high for this company. So the fact that it's flatlining, I think, opens up an opportunity for you to buy here, because even with oil going down, stock price isn't going up. But if we do get an inflection of oil bouncing up, this stock will go parabolic again, guys. And I can say that with pretty good certainty because the reason the stock has been maintaining a flat line is because while oil is going down, their production is exploding. I mean, we're talking about 1.6 million barrels in that quarter, right? Like, that's insane. These are record levels of production, and they just continue to scale over and over. Going from September 30th of 2024, the same quarter prior was only 1.36 million. I mean, the ramp up of production here is, again, incredible. So if you take a look at the overall earnings, especially net earnings was 5.5 billion, for the 9-month ending versus 4.9 billion this time last year. So they're still able to expand net earnings, even on the back of oil prices going down because of the record-setting production. So you kind of get this nice dividend stock that has great growth. It'll flatline in a market like this, but I'm promising you, of all the oil stocks out there, CNQ is the top of my list, and I'm very thankful that it is one of the largest companies in Canada and one of the largest holdings in VDY. Like I said, I used to own a lot of these stocks on an individual basis, but I love that VDY can encapsulate all of these stocks in a market cap weighted way that I love. And it's just every time I look at buying another dividend stock in Canada, I'm like, oh, I already own it through my beautiful ETF. So I'll just keep cost averaging here, guys. But I'd love to know what you think about these dividend stocks because I think they're incredible. I still think there's a lot of room to grow in this economy, even on the back of, again, the rougher economic outlook. And I get it. We can be in a recession, guys, but you have to look at the fundamentals of the businesses here because they might not be impacted by the sectors that are being impacted by, the downturn. Because again, you have to imagine if, and I don't think it's going to be like this forever. We've gone on a very crazy run when it comes to precious metals, but eventually that'll subside. But you have to understand, like, there's no way the precious metal market is going to be highly affected by whatever's going on in the Canadian economy right now. So that can help bolster the entire Canadian stock market. So keep that in mind. This is why you have to stay invested and just keep going, guys. You always be in the market, always be buying, and I'd love to know what you think in that comment section below.